All right, we're going to go ahead and get started. Welcome everyone to the E3 Power Market Forecast webinar series. Today we'll be focusing on ERCOT. My name is Emily Rogers. I'm a senior managing consultant in our market advisory and valuation group. I do a lot of work in Texas, particularly managing a lot of our storage revenue forecasting work, supporting tax equity financing, and looking at renewable portfolios. I'm joined by my colleague Paula Charles here in San Francisco.
Hi everyone. I'm Paula Charles, a senior consultant at E3 in the market advisory team with Emily and member of the ERCOT market price forecasting team.
Awesome. So today we have a brief introduction to E3, then we'll jump into some of the details for our E3 price forecasting approach and methodology. Paula will cover our ERCOT recent market trends, really getting into what's been going on in the market in the last couple of years, particularly the last 12 to 18 months. Then I will cover our 25 plus year price forecast for ERCOT, getting into a lot of great details like our future loads, builds, and exciting kind of resource economics trends that we're seeing. We will reserve time at the end to answer your questions. Please use the WebEx Q&A functionality. It should be a question mark in a box at the bottom right of your screen. Feel free to add questions throughout the presentation and we will answer them at the end. Right, with that, we'll go ahead and get started. So a brief introduction to E3. We are a technical and strategic consulting firm specializing in the energy transition. We're about 150 full-time consultants spread across offices in the US and Canada. We perform about 400 projects per year, executing for over 150 clients. And what makes E3 really unique is that we have a very diverse client base and really approach solving problems in the energy industry and tackling challenges for many different sectors of clients, including public and nonprofit clients, utilities and system operators, and lastly, excuse me, private sector clients, including investors and project developers and owners. Some examples of that include folks across the market design all the way to the load fields. So for market design, E3 has recently supported folks in PJM, MISO, and ERCOT on capacity accreditation and other market design questions. In the generation and storage field, we have supported a number of very large transactions from, valuing companies all the way down to doing very specific, single nodal asset revenues. In transmission and grid enhancing technologies, we've looked at these for a number of different folks. And then lastly, much more increasingly so in the past few years, we've been doing a lot of data center projects and large load work. And across this full stack, we have also been doing utility diligences and strategic support. All of this helps inform our price forecasting and just kind of where we sit in the broader landscape. E3 is a consulting first forecasting approach where we really want to work closely with clients on specific engagements, and the purpose of producing these forecasts is to help them in their decisions and exciting work. So compared to other kind of general advisory companies where they may have many different topics within their consultancies, E3 is really focused on the energy field. And compared to other forecasting companies that may be pushing out very regular kind of subscription packages just for the purpose of kind of loading those curves up in different analysis, we really tailor our market price forecast to be used in engagements and put a lot of hours into integrating our expertise across that full market design all the way through load side into the forecasting package. Great. Last slide on E3 is just some of our recent public transactions. We've evaluated over 35 gigawatts of renewable storage and thermal generation in the last year. We've supported major investments into utilities and transmission. This strength, kind of working with all types and sizes of developers, investors, and financiers across North America, really allows us to put assumptions and market test our price forecasts. Great, and with that, let's get into some interesting trends in Texas. I will turn it over to Paula to first cover our kind of methodology and approach to price forecasting.
Thank you, Emily. So before turning to the ERCOT outlook, I wanted to spend some time on E3's market price forecast and how we approach forecasting in this increasingly varied and uncertain environment. So this first slide here represents E3's forecasting approach built on 3 pillars that you can see on the bottom right. So first, our longer-term fundamentals and trends. So our models are really grounded in the structural drivers of supply, demand, and resource economics. We continuously test our forecasts in the field with over 100 clients and projects annually that are using E3's market price forecasts, and this really enables us to pressure test our product and anchor it to where the market is headed over time. Second, shorter-term constraint and data points. So every member of our forecasting team is actively involved in complex client-facing work, which means that our product really reflects on-the-ground realities and incorporates recent market outcomes. And then finally, continuous policy and market uncertainty. So we make sure that we maintain deeply informed views of policies and markets, but we also want to ensure that we're not over-indexing to recent headlines that may not significantly impact longer-term trends. So our forecast is really at the intersection of those 3 pillars, and this is enabled by our expertise in the industry and our rigorous modeling that's been around for several decades. So this next slide here is presenting E3's modeling ecosystem. So our work, as I mentioned, is really based on fundamental-based modeling and core to capacity expansion and production cost simulation as our core toolkits. The production cost simulation takes hourly load forecasts and dispatches a portfolio of both existing and new build resources to meet those loads. So on an hourly basis, we have supply meeting demands across each market footprint, and the output is our day-ahead energy price forecast, which is really the foundation around which everything else is built. So you can see this whole modeling ecosystem, but I really want to highlight the fact that this is our model across markets, and then we tailor inputs and outputs specifically for each market to make sure that we reflect the drivers and condition of the specific market we're modeling here. If we focus on the capacity expansion side, so we start from current loads, existing resources, and planned retirements. We then layer in scenario-specific assumptions, so load growth, gas prices, technology costs, etc. And then the model determines what new resources the system needs and when. And those build decisions feed directly back into the production cost simulation and into our energy price outcomes. And this is really important context for what follows, because load growth and build rate assumptions, for instance, for ERCOT, have significant implications for where the price is settled. And being able to trace back those outcomes to specific inputs is really what gives the forecast its value. So now that we have seen this framing of our approach, let's turn to what is actually happening in ERCOT. So this slide here lays out the key structural changes that we have seen over the past several years. And then the next following slides I'm going to present will unpack each one. But the short version is this. We have seen strong load growth in ERCOT and high renewable build-out that are really transforming ERCOT's net load share, and they are driving scarcity condition across a broader set of hours and system conditions. So on the load side, growth is being driven by a combination of factors, including data centers, large industrial loads that really run around the clock, but also broader economic expansion and electrification. All of those are raising total energy consumption significantly, but we haven't seen a spike in summer peak demand resulting of this increased energy consumption. And then on the supply side, we have seen rapid build out of storage that's really compressing midday prices and shifting the highest value hours to evening and shorter periods. So if we start with loads, ERCOT is really expecting unprecedented load growth driven by economic growth, data center development, and large load interconnection. And the potential scale and pace of this growth really creates considerable uncertainty in long-term planning. So the chart on the left here that you can see is ERCOT's 2025 adjusted long-term load forecast. So this shows the total summer peak forecast between 2025 and 2030. And you can see in red here the forecasted increase of 51 gigawatts between 2025 and 2030. With roughly 50% of that energy demand expected to come from large load customers. So this is really unprecedented scale. But that forecast has been revised multiple times So the 2025 update actually reduced projected 2030 peak demand by 7 gigawatts compared to 2024, which is really significant, and also reflecting the reality that not all announced large loads will materialize on the timeline that we have initially expected. The 2026 preliminary long-term results have been published a couple of weeks ago, and on those you can see the amount of data center requested capacity increase. So it will be interesting to see how it modifies the summer peak. But this back and forth really highlights the high uncertainty around timing of large loads. And then on the right here, you can see the geographic concentration of data center load growth with all the data centers in development in blue on the charts. And you can see that the heaviest development is really concentrated around the 3 hubs in the South Central, North Central, and Far West regions. The next slide shows how load growth is impacting the system. So when we look at large loads connecting the system, we really have a couple of distinct categories. So first, we have data centers which consume power consistently around the clock and operate at a load factor of approximately 86%. And then you also have large flexible loads, which are mostly cryptocurrency mining, but you also have some hydrogen and natural gas production. There were 3.7 gigawatts of them as of April of last year, and we're expecting this to grow to roughly 8 gigawatts by 2030. And those loads are very specific because they can curtail during scarcity conditions and helping moderate peak demands. So having those different types of large loads coming in the system is really key to understanding the divergence between growth in energy consumption and growth in peak demand. So on this chart here on the left, you can see the year-to-date cumulative load between 2023 and 2026, and it has really increased since 2023 by over 7% in 2024, by almost 9% in 2025, and then it has slowed down a bit in 2026, increasing by less than 1%. However, if you look at peak load, despite this significant energy growth in the past 3 years, peak demand has remained around the same level. So in 2024 and 2025, we haven't seen any meaningful increase year over year in summer peaks, with a stabilization around 85 gigawatts. This is due to price responsive load behavior and forced avoidance, but we believe that the primary driver of this has been the mild weather that we've seen in the past couple of summers. So it will be interesting to see where how much peak load growth we will see this summer in 2026. And I just want to point out another interesting dynamic in that graph that you can start to see is that winter and shoulder seasons are actually in peak demand are actually increasing year over year, with peak winter demand going from around 65 in 2023 to 80 in 2025. So this is another interesting trend. Now let's look at what the energy prices look like. So this chart has a lot on it, and it's showing how the energy prices have been impacted in the recent years. Also how they have been difficult to forecast, and how the system is becoming dual peaking, with winter becoming increasingly tight. So we have several things on this chart. We have the black line that is actual settle price, the different blue dotted lines that represent forwards that we have pulled each year heading into the summer. And so you can see how market expectations have evolved over time. And then finally, the green line here is our 2026 edition of our market price forecast for ERCOT. So, and also all of those lines are day-ahead prices in ERCOT North. So if we start with the actuals, you can see that, and if we start with 2024, you can see that 2024 came in well below expectations. We had forwards heading into the summer, showing prices around $120, $130 per megawatt hours, as we were anticipating a strong summer peak in price. But the combination of no peak load growth and significant solar and storage addition have really kept the conditions loose, and we haven't seen that peak in the actuals. 2025 played out very similarly on the summer side, with forward again in the 100 to 120 range heading into the seasons, but the actuals showed no summer peak. But then, as you can see here, we saw a winter peak that was tighter than many expected in the winter of 2025 to 2026, so this past winter here. We especially saw this in late January, with the winter storm Fern, when that storm hit, where we had day-ahead prices exceeding $1,000 per megawatt hour for an entire evening, and reaching as high as $2,000 per megawatt hour just before sunrise. And this happened as we had strong winter heating load across Texas, and it was also a day where wind did not pick up in the evening, so the demand really put a stress on supply, and as solar and wind were not producing. And this is exactly the type of scenario that our modeling has been showing. So those winter and non-solar hours are increasingly where ERCOT is seeing its scarcity. So it's really interesting to see this showing in real world data. But I also want to highlight that this peak in winter was especially true for day-ahead prices, which is what I'm showing here. But thanks to the winterization effort that have allowed gas to remain up and running, and also thanks to the amount of batteries on the system, real-time prices were much lower than these day-ahead prices. And now, if we look at this year, we have the darkest blue line here is showing the current forward, so that we just pulled a couple of weeks ago. And both these and E3's forecasts have been showing summer and winter peaks at level tighter than 2025, even if they have been revised down from previous forwards. So we're still expecting the market to be tight in these seasons because of the increase in demand that's putting a stress on the system. So it will be interesting to see where the market settles this summer and coming winter. So now that we've looked at the trends in the seasonal trends in the market on prices, I think it's also interesting to shift to what's happening within a day, because intraday price patterns are increasingly where we're seeing the impact on renewable value. So in 2025, ERCOT added approximately 6 gigawatt of solar and 6 gigawatt of storage on the system, but only about 1 gigawatt of wind. And we also have an interconnection queue remaining heavily skewed towards solar and storage development. That level of solar growth is really saturating the system and reshaping the net load profile in very meaningful ways. And you can see this clearly in the energy price graph on the top right in this slide here. Midday hours, which are hours when solar output peaks, are now consistently corresponding to the lowest price hours. And wind, on the other end, is generating more in the evenings and overnights. So those evening and overnight hours are really the hours that are becoming the highest value periods as the system tightens with more around the clock demand and no solar outputs. So we're starting to see wind's value relative to the hub price improve, while solar capture rates continues to decline. And that's what we are seeing on the bottom right chart here, with historically solar has been at a premium compared to wind, but that trend has been shifting in the past few years. And 2025, as you can see, the first year where both lines are crossing, and wind has now a better capture price than solar. So over the long term, we're expecting the market to rebalance towards greater wind development as those value signals strengthen. But in the near term, as I just mentioned, the interconnection queue is still continuing to show more solar build out than wind. So the next slide is showing the recent ERCOT market policies. So I won't walk through every item on this slide, but I just wanted to highlight those because it really reflects something central to our to how we are approaching forecasting. We're always tracking policy evolution and how it fits into our price modeling. And we're not only looking at policies that have already been implemented, so the ones in green here, but we're also monitoring anticipated changes that are expected to hit the market in the coming years. So for example, we're looking at DRS ancillary service products, but also developments around renewable firming and the Texas Energy Fund, both of which have the potential to meaningfully reshape investment incentives in ERCOTs going forward. So now that we've seen what has been happening in ERCOT in the recent years, I will turn the mic back to Emily to talk about our long-term market price outlook.
Awesome. Thanks, Paula. And anyone, feel free to put questions in the chat if you want to hear more about any of these topics. Also want to acknowledge that I get the privilege of presenting our long-term price forecast, but it reflects a lot of work from folks all across E3. So thank you to the ERCOT team. First, I'd like to start by talking about our ERCOT price forecast scenarios. As you heard from Paula, based on all of the recent trends, there's a lot of key uncertainties happening, and so E3 takes a very scenarios-based approach when thinking about our future market price forecasts. On the left-hand side, this is our E3 core case, and this reflects our base set of expectations. Given that there are two kind of major uncertainties, we have also produced the three sensitivities on the right-hand side. The first uncertainty is large load growth, particularly from data centers, since it's one of the most important variables shaping the market. We have produced two sensitivities here. One is the high load growth, which reflects a world in which data center load growth occurs much more quick than our core case expectations by 2030. So adding a lot more data center load by 2030, which causes our model to build more wind, solar storage, and gas to meet that additional load. And this additional load causes near-term system scarcity due to that stress. On the flip side, since this is so uncertain, we also sensitized a low load growth scenario where we reflect a lower peak load in 2030 from data center load growth kind of underperforming, a lot of those projects getting dropped, announced projects being rescinded. And what happens is the system remains well supplied for longer with fewer scarcity events. And in turn, this reduces merchant upside, particularly for storage and gas, which rely on those scarcity events and volatility. Our last scenario is really based on the key uncertainty that wind is such an important generation resource in our core case. Wind's profile, as Paula mentioned, has become really complementary to the potential data center loads coming online that are on kind of around the clock. And in recent years, we have seen kind of slowed development interest in wind in ERCOT. E3 published a white paper on this a few months ago if you're interested in learning more. But that's really contributing to the uncertainty in the pace of wind build, since many of the kind of wind sites that have been, lowest hanging fruit or easiest to develop have occurred already. So we built in this scenario on constrained wind development, which reflects a cap of 1 gigawatt of wind capacity build per year for the full duration of the forecast. And the result here is that we see higher builds of the other available resources like gas, storage, and solar. We see reduced winter scarcity from the higher amount of gas that was built and then therefore runs during the winter. So all of these scenarios are available as off-the-shelf market price packages on our website for purchase, and also are used in consulting engagements. For the next slides, I'll be digging into assumptions for our E3 core case on the left-hand side. And then I think we'll have time also to look into our detailed dashboard view where I'll share some comparisons of the E3 core case and the high load growth case as well. So first, jumping into the E3 core case load components, what I wanted to share is starting in this chart down on the left-hand side, we're sharing gigawatts of average daily load shape where the dark blue is base load, and we're layering on orange data centers, green large flexible loads, and light blue electric vehicles. And one of the most significant trends here as we move from 2026 through 2055 is just the sheer amount of proportion of non-base load that comes onto the ERCOT system. A significant amount of data centers, large flexible loads, and EVs. And the green large flexible loads really start to hit between now and 2035. This is really contributing to increasing the load factor. We see about a 72% system-wide load factor in our modeling long-term. And we see EVs start to play a role later in the forecast, more in 2045 and 2055. And you'll notice based on kind of the average shape that we're assuming managed charging will be able to shift electric vehicle charging into solar heavy hours and out of the peaks observed in the base load, data center, and kind of large flexible load categories. So that's a look at our load over time. Next, we'll look at supply. So starting with near term, we rely on the ERCOT CDR, the capacity demand interconnection queue, and project status to account for near-term builds. On the right-hand side, you can see our near-term capacity builds by end of year through 2030. In terms of kind of dominance, we're still seeing solar and storage dominate the queue. We're about 26 gigawatts of planned solar and 7 gigawatts of planned wind capacity planning to come online by 2030. In terms of gas and gray on the bottom of the stack, we've included all active projects from the Texas Energy Fund, or TEF, and late-stage gas interconnections. So that's about 5.7 gigawatts expected to be added between now and 2030. And then lastly, I'll take a moment here to just talk about the role of storage, which a ton of storage has come on the system in the last 5 years. We're projecting that to continue with approximately 17 gigawatts of planned storage capacity coming online by 2030. The impact of storage has been reducing volatility as well as saturating ancillary service markets. And we've seen kind of 2-hour duration be the dominant duration in recent years, and we're projecting that to continue near term as the kind of need for a longer duration product is not being seen in ERCOT in this time frame. Right, so that's near-term builds. How about long-term builds? Across the full forecast, we see these same resources as important contributors, and nameplate capacity is forecasted to rapidly increase, kind of maintain pace. We see solar and wind having major builds before the ITC, or investment tax credit, and PTC, production tax credit, expire. Same thing for storage when the investment tax credit expires in the mid-2030s. We see kind of the impact of all of these builds. And long run, we kind of see a balanced mix of wind, solar, storage, and gas being built to meet load growth. And these kind of megawatt nameplate capacity builds translate to generation in an important way. Of course, storage isn't a net generator, so here we're showing contributions from nuclear, coal, gas, wind in blue, and solar in yellow. And in the long run, ERCOT reaches about 60% renewable generation driven by energy economics alone, since they do not have any type of binding clean energy or renewable standards. And gas generation continues to contribute a critical part of the energy mix to meet the load growth that we've been discussing. So given the load trends and long-term generation trends, this impacts how we see the load supply balance and in turn what our day-ahead energy prices will look like. So next I'll get into the annual average energy price. We're showing this in nominal dollars per megawatt hour for historical years through the end of our forecast. We've also charted every ERCOT zone, Houston, North, South, and West. So starting from historical actuals from 2022, when we had some intense weather that year, we saw prices drop after that on an average basis year over year. And then we've seen kind of a recent increase, and we're expecting this increase to continue to 2030 as large loads really begin to ramp into the market. And this is kind of the core uncertainty around why we produce the high load growth and low load growth case. So if in high load growth, we see, increased scarcity and higher average prices, and in low load growth, we would expect not such a steep increase based on the timing of those loads. And then solar is being built quickly to capture the end of the tax credit eligibility, and prices are really just rising as demand becomes stronger. In the 2030s, we're seeing renewable investment moderate because there's no ITC PTC. Storage is still being built to capture the last of the ITC, and load growth has kind of started to slow after the initial wave of projects ramp to full. But long term, kind of in the market adjustment and long run equilibrium phases, we're seeing prices rise to the cost of new entry for new wind, solar storage, and gas, as load growth just requires kind of continuous additional investment. And the last trend I want to highlight here is we start to see the west zone in blue pull under the rest of the zones, and that's really due to the strong wind economics in West Texas, beginning to cause a separation that's maintained or changed by additional transmission investment. Great. I'll share one more slide before we can dive into the detailed view as well. And this slide really has to do with Paula's trends that she was mentioning as well, in terms of the relationship between wind and solar. So this slide is showing on the left-hand side for wind and right-hand side for solar. There's a lot of information here for every ERCOT zone, going from light blue in 2026 to dark blue in 2050, the generation weighted price. So we can see over time the generation weighted price are increasing for wind, and that's because it's capturing stronger revenues as the market tightens with load growth. And we saw wind had a really advantageous profile to the kind of continuous load profiles coming online from those large loads. And because of that, wind value is rising with additional kind of overnight strong pricing through 2050. We really see 2050 pulling away, particularly in the Houston and South zones. On the right-hand side, for solar, we're seeing kind of a near-term dip in generation weighted price between 2026 and 2030. This large near-term solar investments are depressing capture prices despite the strong market overall. It's kind of the opposite trend as wind on the left-hand side. But solar saturation, all being built in a very, condensed timeline and producing in the same hours contributes to this trend. But over time in 2040 and 2050, solar value rises with more load growth, but still remains at a discount to wind value long term. You can see the bars on the right in dark blue in 2050 are lower than the bars on the left for wind. Great. With that, would love to take some time to jump into our more detailed dashboard look. We're going to show you some cool trends and comparisons between the core and high case. Awesome. So first we are showing, here is the ERCOT North prices. Just kind of orienting you to this new dashboard view. Is down on the bottom is what we were just talking about with the annual average day ahead price. And blue for the core case is what we've been discussing. And then we're also adding in a great comparison here with our high load case. So I'll take some time to kind of walk through the details and provide some kind of high level takeaways as well. So on the bottom with the annual average day ahead price, we're seeing that the high load case has a higher annual average. This of course doesn't reflect kind of the higher scarcity hours since we're averaging over full years. But on average, the high load case is showing a higher day ahead price. And then if we look at that in the monthly, you can see kind of those winter and summer peaks Paula was talking about in the market trends come to fruition. And on the left-hand upper side, we're showing the hourly average day ahead price. This is not as useful since it's every year between 2027 and 2050, but shortly we'll kind of dive into each month and year. But here in the overall trend, we see that in the morning hours, we have a small peak occurring, and the high load case actually has a lower peak in the morning hours just because the sheer amount of gas and wind that was built to meet the high load that came online. And in the evening, high load, as we expected, has a higher peak than core, around hour 19-20 there. Great. And so I think we'll kind of double click on the hourly average day ahead price by going into the price monthly. And here, what I would love to show you is continued comparisons between the blue core and orange high load case. And this is all for ERCOT North, just to kind of orient you. And we're showing the average daily day ahead price across every month in the year, January through December. So you can see in winter months, and note that the axis auto scales here. So in winter months like January, we may be looking at a peak of $100 per megawatt hour, but you can see in July, August, September, these are all up to $600 or $400 per megawatt hour. And some of the interesting trends we can observe in this type of chart are really the impact of solar on midday price formation. So you can see in winter, kind of even the top charts, I think because of the axis, the impact of as solar is generating and online, we start to see kind of the belly of the duck or the lower midday prices. You can particularly see this in March, where we have high prices both in the morning and the evening. And that really connects to what Paula had mentioned, where in non-solar hours and potentially lower wind output hours, we're seeing increased scarcity occur, both in the morning and the evening. And we see kind of a pointy high peak happening in summer, still peaking in July, and with also very high scarcity in August, June, September as well. And so this was for 2030. If we toggle to 2050, you can see these trends continue as well. In wintertime, we still see kind of the impact of solar, collapsing midday prices. We're seeing increased scarcity. You'll note that I highlighted the January kind of y-axis max being at 100. Now it's at $300, especially as the high load case has kind of pulled away from the core case in blue. And in summer, similarly, seeing some major scarcity in peak hours. And if we kind of just go back to 2030 and 2050 a few times, I think we can see really the kind of sheer impact of higher peaks and some of those seasonal changes. Great, so that was a look at our kind of detailed daily shapes over time and a comparison between our core and high load case. Next, I want to share one of kind of our favorite internal pages to look at, which is the operations overview, really thinking about how all of these different resources are generating to meet load. And this is important for our price formation. So here I'm showing ERCOT wide the hourly generation for the core case. And I know it's a really busy chart. We like to, call it the Jackson Pollock type chart, although we've made it a little bit more organized recently. But we see kind of our baseload resources generating at the bottom, black, coal, gray, gas. And if we shift maybe just into 1 week, like the second week of July, we can see these trends kind of more easily. Excellent. So you can see solar is generating in yellow midday, and gas is decreasing output during those hours and then increasing output again when solar starts to ramp off. Really interestingly here, you can see the impact of storage even in 2030, which is awesome, starting to come online when solar is coming offline. We've also called out a special battery charge and discharge chart as well, so you can see the hours when storage is charging, which is all during solar, and then discharging when it's ramping off. Wind continues to generate throughout this time as well, kind of the top of the stack here in placement. So just a fun way to look at kind of what's happening within the day, look at specific days, especially ones that are extremely tight or exhibiting interesting kind of generation data, like some of the March dynamics that we've been talking about. Excellent. The last page that I would like to share here are our TBX revenues. So this is specific to storage. Earlier, I shared a slide on the generation weighted prices for wind and solar. For storage value, we instead like to use a top-bottom calculation as an indication of revenue. And this is done by duration. So TB2 for a 2-hour battery or TB4 for a 4-hour battery. And this simple calculation is just essentially what are the top 2 hours in each day and bottom 2 hours in each day. Assume the battery, charged at the cheapest hours, discharged at the most expensive hours for its duration, account for a simple round trip efficiency. And that gives us an idea of the battery value given these simple daily spreads in the day ahead market. So we're showing TB2 revenue and TB4 revenue in the ERCOT North Zone for the core case in blue and high load case in orange. And you can see that TB revenues for batteries remain really seasonal over each year, making a lot of money when there are scarcity months, like we talked about in kind of February, March, as well as July, August, September. And you can see the battery margins are higher for the high load case, since that has produced, in general, a tighter balance between load and supply. And for the TB4 case, you can see that captures higher revenue since it's a longer duration battery, and is able to capture all of those different spreads. So just wanted to share some trends in just energy only kind of market revenues here for storage. Excellent. With that, I am going to flip back to our slides. If you have any questions, this is a great time to think about putting them in the chat. I would love to say thank you so much for joining today. That's the detailed content that we've prepared. But the E3 market price forecast, including ERCOT, the core case, high load growth, low load growth, and constrained wind development scenarios are all available for purchase at our E3 shop. This kind of link will include really detailed assumptions on what comes in the market price forecasting package. There are example deliverables, including the assumptions book, market slide deck, like many of the slides we shared today, and many, many more. And then the Excel kind of hourly, day ahead, real time, and ancillary services prices. While we've been talking about ERCOT today, there are also price forecasts for every other market in North America. And second, please reach out to us directly if you'd like to discuss any questions or custom engagements. We're always happy to chat. There's Paula and I's information, as well as Grant, who will be joining shortly. And lastly, please feel free to follow E3 on LinkedIn for future insights on ERCOT and our other markets. Excellent. At this time, I would love to welcome 2 additional members from our ERCOT team, Grant Freudenthaler and Dave Maggio, to come join us for some Q&A. Excellent. And while we look at the questions, the first question that I would love to hop to, and Dave, I think we can send this your way, is what has been the impact of the RTC co-optimization in ERCOT?
Yeah, absolutely. Willing to talk about it. I guess for a little bit of context, I'm a recent member of the E3 team, but before that, I spent a little over 19 years actually at ERCOT. So hopefully, I have some good insight to some of these more recent topics. In terms of what we're seeing with RTC, I think it was a lot of the things that were expected. So you're seeing reduced costs generally. You're seeing reduced costs around congestion. You're seeing improvements in terms of the out of actions needing to be taken by the ERCOT operator. So all those things were expected and do appear to be materializing. And of course, there's other factors at play, as you all were talking about, with the proliferation of storage and the impacts there and ancillary service prices. And I think this ties to one of the other questions we'll probably hit on in a moment. Probably one of the more interesting things to watch now in the near future is the reliability assessment that's ongoing right now and the market design options that come out of that as the group begins to focus a little bit more on long-term resource adequacy in a world where we've now added some additional efficiencies with real-time co-optimization.
Excellent, thank you. Yeah, I'm seeing a lot of really well-informed questions in the chat. It's great to have such a ERCOT savvy audience. I think the next question that I'd like to go to is, how are the data center risks modeled in here? How are you thinking about large load flexibility? Maybe Grant, you could talk more about how we reflect large flexible loads.
Thanks, Emily. Yeah, happy to. So I'm Grant Freudenthaler, Associate Director here at E3, member of the ERCOT team as well. And so we thought for this refresh, Paula had walked us through the observation that as energy was growing in Texas, we actually haven't seen that peak load growth yet, which made us really want to dive in and rethink, how are these loads behaving? And a lot of that research led us to start to model the flexible loads more sophisticated. And so what we ended up doing is we include them in our hourly production cost model as a resource. And so when prices start to get high, this load literally turns off in the production cost model, mimicking what we're seeing with things like Bitcoin mining and other industrial flexible loads. And so this also includes 4CP, as well, as we expect that high prices and 4CP typically are correlated. And so the model is picking that up. And what we've seen from that is that when the loads are responding as they do in the market now, especially to prices that are in the, let's say, starting at the $75 range and up, we're really starting to see that impact price formation. And it really does take quite a bit more to get into those scarcity hours with this new activity. So that is how we're thinking about the flexible loads right now. And that was one of the bigger impacts to our forecasting methodology to incorporate that.
Awesome. Thanks so much. An important kind of second part of that question is how are we thinking about bring your own generation or BYOG from large loads?
Yeah, I can maybe take that and we can maybe pass it around the panel here. But in terms of the modeling, when we look at the long-term expansion, we're agnostic to sort of where that gas shows up. So the gas build that comes out of the modeling is based off of the energy-only economics that are in there and maintaining a level of reliability that makes sense with the market and with pricing. And so if this gas generation were to show up on site of a large load, sort of the model is agnostic to it. We would expect the price formation to be the same in terms of how prices are formed in the model. But Dave, did you have any insights maybe to add on bring your own generation or gas availability to on-site or anything like that?
I mean, in terms of the modeling, I think what you're saying makes sense, Grant. I think in addition, go back to the broader question on modeling flexible loads. I think it fits into that very well too, in terms of how you think that's going to get utilized. Some of the things coming out of SB6 as those we're taking the legislation and converting that into specific rules. So I think a lot of that's all going to tie together nicely.
Excellent. Next question is, how are we thinking about modeling the economics of longer duration storage? And where do we see longer duration, as in greater than 2-hour projects, start to actually get traction in ERCOT? And I'm happy to take this one. We model storage in kind of 2-hour duration buckets. So we have been modeling 2-hour, 4-hour, 6-hour, and 8-hour in our model, and seeing really when longer duration than 2-hour makes sense is when we have kind of a longer high priced period in the evening, right? There are at least 4 high priced hours. Right now, as we saw in kind of the average daily shapes, we saw like really narrow peaks, and on a day-to-day basis, we see that as well, where 2-hour can really hit the highest hours of the day. In the future, even in kind of the late 2030s and 2040s, we start to see that peak extending more similar to markets, maybe like the beginning of California's type shape, where 4-hour storage can become more economic in the future. I will say that I think most folks consider long duration storage as almost 12 hours plus. That's not something we've seen get picked up in our models, at least in the next 20 years of the forecast.
Yeah, Emily.
Awesome. Yeah.
I was just going to add to that too, that exactly right. As you pointed out, over time, we do see that that shape start to expand, where the top 4 hours, the economies of scale of going from 2 to 4-hour generation, that benefit starts to pick up. But as you mentioned, it's quite late in the forecast, and we really only see 4 hours as long as it wants to pick. Sometimes it maybe wants to go a bit longer near the 2050s, but certainly nothing like 8 or 12-hour like we would see in California.
Totally. Awesome. Another great question is, nuclear has been seeing a resurgence in interest. Is that reflected in the outputs?
I can take that one too, Emily. So our long-term expansion model absolutely includes nuclear every single time. And typically what we find is just that with Texas having, some of the best wind and solar resources combined with the availability of storage and gas, the levelized cost of that fleet really is as competitive as it gets. And so at the current price points we're expecting nuclear to be in, we're not expecting it to be developed anytime soon, competing with those economics. And then later years, it all depends on what the learning rate of nuclear deployments are. If we do see cost declines in the future that are substantial, I expect that it would maybe begin to be able to compete in Texas. But until we see evidence of that cost decline, it's a pretty tough hurdle to beat the wind solar storage combo combined with gas in our long-term expansion modeling.
Yep, absolutely. Great. And a follow-up on the ERCOT reliability standard assessment, what market design changes do you expect to come from ERCOT's reliability standard assessment? How might different options affect fuel mix over time?
Yeah, and I can maybe take the beginning part of that, and others can think about what that means in terms of the modeling. To be honest, I would generally expect probably some of the usual suspects to be showing up as part of the options. things that have already been discussed. So for example, ERCOT had previously discussed with some work from Aurora, looking at the dispatchable reliability reserve service, calling it an ancillary service plus. So sort of expanding on just having as a more traditional ancillary service. I expect that to continue to be part of the conversation, as well as just general changing to some of the scarcity pricing mechanisms with the ancillary service demand curves, things of that nature. Again, a lot of the things that you've seen probably in previous studies, looking at ways to expand that now with a specific reliability standard in mind for this upcoming assessment.
Excellent. No, I think that answers it. Great. Last question I'm seeing in the chat, if anyone else wants to chime in, feel free to do so, is do you have insights on wind and solar curtailment and negative price formation? Great question. Who wants to take it?
I can take that one to start, but I think maybe we can go around the horn on that one. At least from the modeling perspective, Emily, you pointed out in our long-term averages that West Texas has a bit of a separation at the end. And so we're seeing that, with the best wind and solar resources being there, and also this all depends on the transmission build and where loads are distributed, but Paula walked us through some of where the data center hubs are. And so if we expect that renewable generation to outpace large load development, with the exception of perhaps the Permian electrification in the West, those are sort of the two big balancing ones, but we are seeing as more and more renewables are added into the West, we see storage wanting to build there as well to soak some of that up, but that's where the most negative price formation is happening in the modeling. And creating some meaningful separation. We're seeing things like the full production tax credit being a sort of a floor on those negative prices in the West, as a lot of those generators will have that. And we expect the curtailment to be high enough to get through to those generators that are able to offer that price.
Yeah, maybe Grant, I'll only add, I thought the display that we saw for March, looking at the 2030 case was very telling, and in fact is in alignment with what's already being observed in ERCOT during those shoulder months. Just definitely seeing an increase in terms of the amount of not just low pricing, but negative pricing, something that was otherwise typically reserved for kind of those night hours with high levels of wind. So definitely already growing and obviously coming through in the model as well.
Yep, absolutely. Storage will look forward to taking advantage of those negative price charging hours. Like, already know it. Awesome, seeing a couple more comments and questions coming through in the chat. I'm really glad all of you have enjoyed the presentation. Great question is, what role do you see distributed energy resources playing in shaping grid resilience and future grid in ERCOT? Yeah, thanks so much for bringing that up. I know that's not a topic that we've talked about yet today. I think load flexibility and distributed energy resources are an exciting area, and it's a little uncertain in terms of how they will kind of shape future supply and how big of a stack you could actually see them participating in. But it's certainly something we are watching closely and participating in a lot of projects kind of across the US as well as in Texas. Anything ERCOT specific that would be helpful to add though, Grant?
I think maybe just the impact of you showed the average profile for electric vehicles as that becomes a bigger part of the grid. And that managed profile, certainly being where solar is going to be really key. And so if we can see a managed charging paradigm sort of match up with where all the solar hours are, that would certainly be very advantageous, is sort of one takeaway from different EV shapes we've tried in the model.
And maybe if I can just add to that, I will say that trying to engage distributed resources, demand side resources is high on ERCOT's priority list. In fact, at the board meeting just last week, they had a topic really getting into that. I think there is a question of, as ERCOT looks to reevaluate the programs that they have, create new programs, there's always the question of, if they build it, will they come? And there's just a high level of uncertainty, even though there's a tremendous amount of focus on it.
Excellent. Yeah, really appreciate the questions and discussion. I think that's where we'll leave it for today. So thank you all so much for joining, and thanks for bringing your great questions as well, and hope you have a great rest of the day. Take care.
Thanks, everybody.